very important theoretical concepts, most notably the efficient return at a portfolio level that will be an important factor to gives me the equivalent of covariance. So I'm going to have my -1 for the correlation multiplied less and less actually becomes just the weighted average of the standard deviation of the components and lies somewhere, linearly between the two. So what I want to show you is that for combinations of y and z under the assumption that correlation is +1, the resulting portfolio, depending on the actual mix of y and z, so it's a risk-free portfolio. Deviation of the other gives me the equivalent of covariance. So I'm going to have my -1 for the correlation multiplied by 1.826 and can't fit it in 3.651. What I've got over here now highlighted in green is effectively the covariance between these two things. Now I'll need to put this all into my calculator and, remember that if your calculator is properly set up in AOS mode, which you do in the formatting, section sort of function, formatting menu, whatever it's called. That it's still going to be 0.00. And look, I'm looking on my calculator at 0.00. You know, 0.004. If I take the square root of that, it's still going to be 0.00. So the answer to this one is A. And I did this, you know, I set this question up in such a way as to show you that when you've got perfectly negative correlation between two assets, it is possible to construct a portfolio that actually has zero risk, zero variance, or zero standard deviation in it. So it's a risk-free portfolio. That's actually what happens when you've got, for example, when you're using derivatives that are a perfect offset to some underlying asset. You can eliminate any variance in the overall position. Now, the key takeaway here isn't perhaps your ability to compute and apply the formulas, although that is something you may have to do in the exam. You know, be ready for it. But I want to now jot some takeaways down on a graph. And this is an extremely important depiction that I'm now going to draw here. So on the vertical axis, we've got the expected return on the portfolio. Here we've got our measure of risk, which is the standard deviation. And I'm just going to start off by noting that the assets, the two assets that we had here, asset Y and Z, expected return 4 and 8. So let's say this corresponds to 4%, and let's say this corresponds to 8, and I'm going to have 1.826. That was the standard deviation of asset Y. So, you know, this point over here lies on the intersection of expected return and standard deviation that is characteristic for asset Y or stock Y. And then for asset Z, we had 8% expected return and 3.651 in terms of expected standard deviation. Okay, well, let's have that. That's roughly twice. So let's have that over here, 3.651. Okay, and that's going to be my point Z. Now, when we assumed that the two assets were perfectly positively correlated, we discovered that the formula for the standard deviation of the portfolio actually becomes just the weighted average of the standard deviation of the components and lies somewhere, you know, linearly between the two. So what I want to show you is that for combinations of Y and Z under the assumption that correlation is +1, the resulting portfolio, depending on the actual mix of Y and Z, how much of Y and how much of Z you put in, is going to be somewhere on this axis. We had actually, you know, sort of 2/3 of Y and 1/3 of Z, so we got pulled more towards the Y, and you know, I guess we ended up somewhere here. Now, on the very opposite scale, when we assumed that correlation was negative, but negative at -1, we got a portfolio that was characterized by 0 standard deviation. So it was lying somewhere here in terms of, the horizontal axis. We can quickly just compute what the return would be, expected return on a portfolio. Let's just check the weights again. We got that 0 for standard deviation, but the weights were 2/3 and 1/3 respectively. So 2/3 of asset Y, which had a return of 4%, and 1/3 of asset Z, which had a expected return of 8. Let me just quickly work that out on the calculator. 2/3 times 4 plus 1/3 times 8. Wait again, got something wrong here. 8/, okay, well, that's fine. And 2/3 times 4, okay, that equals 5.33%. So somewhere here, I don't know, maybe that's the right place, we'd have 5.33%. And actually, when you've got an asset, or two assets with perfectly negative correlation, you get combinations that lie, well, it's not a straight line, it's not even a curve, it's this kind of two lines here, but it's possible to construct with the right weights, right, a portfolio that looks like this, and it's got 0 risk for return at a portfolio level that will be just the, I guess we ended, right, that are, we'd have 5.33%. And actually, when you've got an asset, or two assets with perfectly negative correlation, you get combinations that lie, well, it's not a straight line, it's not even a curve, it's this kind of two lines here, but it's possible to construct with the right weights, right, a portfolio. Well, it's not a straight line, it's not even a curve, it's this kind of two lines here, but it's possible to construct with the right weights, right, a portfolio that looks like this, and it's got 0 risk. For other weights, it will be somewhere on these two lines. For anything in between, which happens quite a lot in real life, so correlation between the two assets being not +1, not -1, but less than 1, you'll get a mix of portfolios which depends on the actual correlation. So here you've got correlations that are less than +1 but more than -1. Less than perfect correlations means you get the benefit of diversification, because you can keep earning the same expected return. Remember, expected return is always driven simply, irrespective of correlation, by the weights of, it's the weighted average of the constituent expected returns. But when you change the correlation between them, or when correlation becomes less and less positive, less and less perfectly positive, you get the benefit of keeping or being able to attain the same level of expected return, but with lower risk. So we shift to the left-hand side here. So let me write this down. It's a big takeaway within portfolio theory. With correlations that are less than +1, portfolios with the same return, because that's simply determined by asset weights. But this is the critical thing: lower risk. with also the possibility of going down all the way to zero in the case of perfectly negative correlation. Right. We'll be for sure coming back to this picture later on as well in subsequent videos. Now, just a final message here. When you start working with portfolios which consist of more than 2 assets, right, for larger portfolios, what actually becomes at some point reasonable is using a formula where the variance of the portfolio, that standard deviation squared, equals sigma bar squared. So that's actually average variance of the average from all the constituents in the portfolio divided here by n. N is the number of constituents in the portfolio, so the number of assets like stocks that you've put in, plus n minus 1 divided by n times covariance bar. Now, covariance is, of course, the average covariance between the pairs of assets. And a takeaway that I want you to sort of, don't remember this formula, I don't think you'll have to apply it, but as n grows, so the number of constituents in a portfolio becomes bigger and bigger. This first term becomes smaller and smaller because we're dividing by n here, so it actually approaches 0, and what's left is over, the term on the right hand side. But with a very, very high n, this actually gets very close to 1, so you're ultimately just left with average covariance. So the takeaway is that for large n values, large number of constituents in a portfolio, overall portfolio risk is very much determined by covariance between the assets. And also recall that covariance is can be decomposed into correlation multiplied by the standard deviation of the individual assets. So the more you can get that correlation to be, those correlations to be 0 or even negative, the more you can push that covariance down. Now, in reality, it's difficult to have assets that have negative correlations, to be honest, but closer to 0 is absolutely possible. The way to create more diversified, less risky portfolios is to keep adding stuff that's not highly correlated with what you've already got in the portfolio. That's how you reduce the very important theoretical concepts, most notably the efficient frontier, but also some others. No numbers realistically in this in this video, no numerical problems, but a lot of information that may lend itself quite well to theoretical problems on exam day. So I'm going to start off with a concept known as the investment opportunity set. Now, all of these are sort of very theoretical constructs. Taking off where we left in the previous recording, where we started to link assets with less than perfect correlations, we're now going to think about what happens when we expand the number of assets available. We expand the number of assets available to the investor. Obviously, then the number of combinations grows, and computing the risk return profile, especially the risk of a portfolio composed of numerous assets, becomes increasingly difficult. Or the number of combinations becomes increasingly large, and it becomes more difficult to do the computations. But if we try to portray things on that standard framework, where on the one hand we've got the expected return on a portfolio, here we've got the sigma, the standard deviation of it. We're going to stick to sigma for now. Later on, we will make the switch to something called beta, which is a measure of focusing on systematic risk only. So let's say that we've got numerous here dots, and each one of these dots represent, some individual asset into which we can make an investment, which is investable. So these are our individual assets. Now, when we combine them together, we get even more sort of these connections, and there is a limit to all this. Oh, by the way, all of these are risky assets. That limit over there on sort of that curve is the boundary of what we can achieve. So we can achieve anything that's on that boundary, on that curve, and everything that's within or to the right of that curve is also achievable. This is the so-called investment opportunity set. Now, your book also says, so these are the points on the curve that are attainable via combinations of different, assets. But obviously, everything to the right of the set is also attainable, although it's not realistically desirable necessarily, which we'll talk about in a moment. And your book says, and there's an interesting thing that happens, that if you think about this as the domestic opportunity set, if you venture outside your own country, your opportunity set becomes even better. Not sure if that's drawn right. Okay, let's draw it like this, in the sense that it moves to the northwest, in the sense of sort of geographical direction. You can, for the same level of risk, get an even better return, or for the same level of return, have a portfolio with a lower amount of risk than if you stuck only to the domestic opportunity set. So this is the investment opportunity set, but one including international assets, not just domestic. Right, now where does this take us? In reality, right, if you can construct portfolios that lie on this investment opportunity set, international, domestic, it doesn't really matter right now, you wouldn't really go for anything that's to the right of that curve, because any asset that is here, for example, is going to be less desirable than an asset lying on the curve. So let me try to depict this graphically again. I'm going to draw. See, in this lesson, or in this video, we're going to have many instances where we draw something, and then we kind of say, but in reality, it's better to do something else, and that's another instance. So I'm redrawing the same thing, but now I'm going to make some, hopefully, good conclusions here, rational conclusions. So this is the investment opportunity set. Again, anything that's on any combination of risk return that's on the investment opportunity set, on that curve, is attainable for the investor. But so is anything that's between here, everything to the right. So this represents our universe of attainable, possible investments. So, for example, this wouldn't be attainable because it's on the wrong side of the curve. So that's an unattainable investment or an attainable portfolio. You may be thinking, well, that's a stupid, point to make, but your book does talk about it, draws on the graph, or that points to certain things on the graph saying this is not possible, but something here is possible. Yeah? And now that comment which I made, if you were able to make an investment, over here into a portfolio over here with a certain level of risk and a certain level of expected return, but at the same time you could make an investment into a portfolio that lies on the curve. Let's call this portfolio B and this portfolio A. Assuming you are a risk-averse investor, which most people are, for a risk-averse investor, so somebody who doesn't intentionally pursue risk, and for some, it's not. Where a risk-averse investor is somebody who doesn't get additional utility from taking risk. They prefer less risk to higher risk. A is a better investment than B. So this one is better than this. Why? Because they've got the same level of expected return over here. But A has lower risk. A has lower risk, and that's the sort of important thing. Now, on top of this, some really, really important comments. The curve itself, right, is going to be described as the minimum variance frontier. So all the portfolios that lie on it are minimum variance portfolios. Minimum variance portfolio. Sorry, this is frontier, but I keep saying one thing and writing another. So the minimum variance frontier is composed of portfolios with the lowest level of risk for a given amount of return. For example, portfolio A for that given amount of return represents the lowest risk. Or if we wanted to focus on some other level of return, over here, expected return over here, that portfolio allows you to get that return with the least amount of risk. Everything that's on the right, that's attainable to the right of that point, is going to be pose more risk. So the logic is, investors should only be concerned about those portfolios which lie on that blue curve, right? Anything to the right of it is less than optimal. Yeah, that's true. But we're now going to make an even more sort of strict point here. Let me just say that on this line, there is on this curve, on this minimum variance frontier, there is an important point which I will label with this black dot here, and I'll say that this is the global minimum variance portfolio. It's basically a portfolio lying on that minimum variance frontier with the lowest of all risks. So portfolio with the lowest risk among all portfolios consisting of risky assets. We are, in this discussion, at least so far, not mentioning and not including the opportunities or the possibility to invest in a risk-free asset, so an asset which is devoid of risk. Later on, we will introduce that. Well, very soon we will introduce that, but not yet. Right. So we kind of, so I've already said, investors shouldn't really be concerned with anything that's to the right of the minimum variance frontier. The minimum variance frontier is that, blue curve here. That represents a combination of portfolios which have the lowest level of risk for a given amount of return. But then you kind of have to, thinking about possible optimization, ask yourself the question, is that where we should stop optimizing? Because surely you can also optimize across the other dimension. For a given level of risk, you want to get the maximum level of return. So if an investor is, let's say, feeling okay about taking on this much risk, why would they go with this portfolio when they can also attain a portfolio that has a lot more return for that given amount of risk? And that leads us to the conclusion that realistically we should, as investors, only be focusing on that top half of the curve, which I'm now trying to mark in a different color, but it's not really working well. Let me use maybe a stronger color like this one, this magenta color, and have, full coverage. Okay, that looks better. I mean, it doesn't look very nice, but at least it's nice and clear. So what I drew there, let me write it down as well here. This is known, and this is an important result, as the Markowitz. This is the surname of the economist who came up with this idea. Efficient frontier. It represents portfolios with the highest return for a given amount of risk. And you may be asked, I think there's even a question like this in the end of chapter questions for this chapter. You may be asked to describe this, or kind of correctly identify the description. Please appreciate that these are portfolios that are on the minimum variance frontier, because they're still on that blue curve, but lying above this point, which was the minimum variance portfolio point. So the Markowitz efficient frontier is composed of points above and to the right of the global minimum variance portfolio. So let's just take a quick look at the sort of progress that we made here. We started with the idea of there being some investment opportunity set composed of individual assets, but also combinations of those assets. So that could be domestic, that could be international. Then you say, well, let's just focus on that very edge, the curve here, because that represents the optimal combination of, for a given return, the lowest amount of risk. But then we said, no, but let's also optimize the other way. For a given amount of risk, let's focus on those portfolios that give us the maximum possible, the highest possible return. And that's how we ended up on that, I don't know, magenta, whatever color this is, line, which is known as the Markowitz efficient frontier. And please appreciate that you may be asked about this. This is the efficient frontier or the Markowitz efficient frontier. But before that, we had the minimum variance frontier. That was the whole sort of U shape. And before that, we had the investment opportunity set, which also included all the investments that were lying sort of here in the middle. So it wasn't just a curve with points on it. It was everything in between the curve, or to the right of the curve. And now we continue this optimization because we will actually now introduce a risk-free asset into the onto the scene. So again, I'm drawing the same setup. I've got the expected return on the portfolio over here, and the measure of risk, which for now is going to be sigma or standard deviation. I will draw that U shape again, okay, and say that, of course, somewhere here with the lowest risk of all the sort of risky portfolios that can be created, we've got our global minimum variance portfolio. That therefore becomes, well, maybe let me use a different sort of thickness line. This one is going to be better. This is the Markowitz efficient frontier. The only theoretically set of asset portfolios that we should be thinking about, as they maximize that amount of return for a given amount of risk. But now let's also say that realistically we have risk-free assets. So this is a risk-free asset, and the return on it is going to be typically denoted as RF. And what would happen if we try to combine a holding of the risk-free asset, which by the way has a sigma of 0, so it's got a risk level of 0, with something that lies on the efficient frontier, maybe a portfolio over here? Well, you could get any combination of the risk-free asset and an asset lying here. It's a straight line, not a curve, because when it's not about correlation, when the sigma of one of the components of a portfolio, when its measure of risk is 0, the whole thing becomes a linear function. And in a subsequent video, I'll do that mathematically as well, I'll prove it mathematically as well. But for now, just trust me, it's a straight line, this combination of a risk-free asset and a risky asset. We call that line the capital asset line. Sorry, not capital asset line, the capital allocation line, apologies for that. The CAL. And this is just some CAL, let's call it CAL A. The thing is, this capital allocation line allows you to, by changing the proportions of the risk-free asset and that risky asset from the or risky portfolio from the efficient frontier, allows you to attain all of the portfolios that lie sort of in between. But we can do even better, because you could easily draw another capital allocation line that has a steeper slope. And I'm quite happy with this result, because I've drawn now a capital allocation line which has a steeper upward slope, and any point on it is going to be superior to what's on the capital allocation line drawn below, because for the same level of risk, you can get a better return, or for a given level of return with that second line, this one, you can get a lower level of risk. Now, this point at which the capital asset line, allocation line, sorry, keep saying asset here, at which these are theoretical constructs. You don't use them when you work in finance. You only use them to teach about finance theoretically. This point, lying on the Markowitz efficient frontier, is described or known as the optimal risky portfolio. But don't cling on to this for too long, because in a later video we'll substitute this for the market portfolio. And if you'll forget about this one, well, you only need to remember it for the exam. It's the optimal risky portfolio. Why? Because it provides the best combination of risk-free asset and risky asset. Nothing beats this, right? Now, you can construct portfolios lying on this line, which are anywhere between the risk-free asset and the optimal risky portfolio. So points that you see over here on this, once again, magenta line, are such where the weight of the risky portfolio is less than 100, which means less than 100% of the money is invested in the risky assets, and obviously leaving some space for investment into the risk-free asset, and you can get something that lies over here. But also, absolutely attainable are portfolios lying on the other, let's say, segment of this line, and this is where we introduce the concept of leverage. How can you get a portfolio which is all the way up here, which produces a return that's better even than something on the efficient frontier? Well, via leverage. This is where the weight of the risky portfolio is actually more than 100, which means we do it by leveraging the investment. That happens by borrowing money, so as to put more money that you've got into that optimal risky portfolio. Leverage by borrowing at the risk-free rate. Okay, and let's call this this was a capital allocation line. This is a capital allocation line. Let's call it P because it goes through, the optimal risky portfolio. That's how your book describes it. And the big takeaway is that portfolios which are on the capital allocation line P are superior, better to those on the efficient frontier, because for a given amount of, let's say, risk that you take, let's say this much risk, a portfolio on the efficient frontier gives you less return than the portfolio lying on the Cal P, although here you have to leverage up to achieve that return, but it's still got the same amount of risk. And but even without leveraging up, let's focus on this level of risk over here on the axis. If we take this line up, you have something on the efficient frontier over here, this point, but the capital allocation line provides an even better return. And actually, it also gives us access to portfolios that for a given amount of return produce risk, and those were even not attainable when you just focused on the efficient frontier. So a lot of interesting things happen. That line is definitely to the northwest, up and left of the efficient frontier, which is why it's so useful. Now, an associated concept is the two-fund separation theorem, which sounds worse than it is. It sounds terrible as a name, but what it basically states is that all investors, everybody, should hold a combination of two things: risk-free asset and that optimal portfolio of risky assets from the efficient frontier. Optimal portfolio of risky assets, and that optimal portfolio comes about from identifying a point on the market-based efficient frontier where you can draw a line from the risk-free asset running tangent to that efficient frontier curve. Where those two touch is going to be your optimal portfolio. It obviously will change with the level of the risk-free rate. And actually, it's just a theoretical construction. In reality, we don't really do this, which we'll discuss in a subsequent video. However, let's just go back here. How much you hold of this and this, or indeed you can go and make this the weight of the risk-free asset investment negative when you borrow at the risk-free rate so as to invest more than you've got in the optimal portfolio of risky assets. But the weights which you apply to each one of these weights depend on the shape of that individual investor's indifference curves, or indifference curve, which in turn is very much dependent or a function of their risk aversion parameter, something you may remember from a previous video, that parameter called A. So, one more time. The same setup: expected rate of return on a portfolio, the level of risk on the portfolio. Efficient frontier, risk-free rate, risk-free asset, and let's draw a nice capital allocation line, right? Happy with where I drew this. What you will choose, or which point you'll choose on that line. So what weight would you give to the risk-free asset or the optimal risky asset portfolio? Depends on the shape of your indifference curves. So if you've got an investor who's relatively risk averse, so they've got a indifference curve that goes steeply up, you're going to try and find the indifference curve, the optimal indifference curve for you. And it may be, this point lying on the highest attainable indifference curve. you can't get this much utility because this portfolio is unattainable. This is unattainable. This is unattainable. The only things that are attainable, are lower. But if you want to maximize utility, you have to choose a portfolio lying on your highest possible indifference curve, which would be this one. Somebody who is going to be more tolerant of risk may have a completely different indifference set of indifference curves like this. And once again, choose something that's attainable and lying on the highest possible indifference curves. So don't go for the ones below. This is how you maximize utility, and you'll choose a point here. Somebody who, once again, is very tolerant of risk will have a relatively flat function, and maybe that's going to be their preferred portfolio or optimal portfolio given their level of risk aversion. Right? So that's the kind of thing we're talking about. Now, in reality, it's impossible to construct indifference curves and impossible to really construct the optimal risky asset portfolio. As you'll see in a subsequent video, we just go with what's known as the market portfolio and use proxies for it. Okay, just a few little points, mathematical points, just in case you need to do this, right? When you try to mathematically compute the expected return on a portfolio, but now composed of a risk-free asset and something that is indeed risky, I call this the optimal risky portfolio, right? Remember, expected return always is just a weighted average of the returns on the two assets. So the weight of one asset times its return, I'm going to say that asset one is going to be my risk-free asset, so times RF here, plus the weight of the other asset, which is that optimal risky asset portfolio. But instead of even writing W2, weight of the second, I'm just going to say 1 minus W2 times its expected return. That will give you the return on the portfolio. And you just have to optimize for the weights given your indifference curves and their shape. Now, what about the risk? Well, let's measure risk as variance, so that's sigma squared. And I'm going to call up a formula that we used in a previous video to measure the level of risk for a portfolio of assets. And then you'll see how greatly it simplifies. Weight of the first asset squared times its level of risk. But this first asset is the risk-free asset, so this will actually equal 0, plus weight of the second asset, which is 1 minus the weight of the first, times its standard deviation. Let me say this is sigma I, just like here I had expected return I squared, plus 2 times the weight of the first, the weight of the second, and now you may remember that we had the covariance term here, the covariance between the risk-free asset and whatever risky asset we've got. And this could have been rewritten as the correlation between the risk-free asset and the risky asset multiplied by the sigma of one and the sigma of the other. That's how you substitute for covariance. Because it's a risk-free asset, sigma f just simply equals 0, meaning this is 0 and this is 0 as well. So this long term and this term just get kicked out, and what we end up with, and we can actually lose the squared, the power of 2 stuff here, is a sigma of the portfolio equal 1 minus W1, the weight of the risk-free asset, squared without the squaring because we've gotten rid of to the power of 2, times sigma I, just like that. So that's why I told you we can draw, what was it here? It was here. We can draw a nice straight line linking the risk-free asset to a portfolio lying on the efficient frontier, on that market with efficient frontier, because not only is expected return a weighted average, so is the level of risk, so is standard deviation. It's also a weighted average, except that the first component has a weight of 0, has a level of risk of 0, so we're just left with the weight of the risky asset, because W1 over here is of course the weight of the risk-free asset, and it becomes not a nice straight line function. Okay, hopefully that's clear. We will draw on this later on as well. Now, the capital asset line, not capital asset, capital allocation line, sorry, I just keep making that mistake. Capital allocation line P, the one that is tangent to the efficient frontier, the one that's, I said is so optimal, it will have an intercept. So the point at which it crosses the y-axis of RF. After all, everything begins here at RF, so that's the intercept of the line, and its slope, right? This is important for later on when we start dealing with beta. You have to understand things like the slope is given as, now, over here you've got the expected return on the risky asset or the risky portfolio. Here is its level of risk, and this is RF. And the way we calculate the slope is we take this distance and divide by this horizontal distance to show how much additional return we get above the risk-free rate for each unit of risk taken. So mathematically, and we will also go through this when we discuss beta computation, you get expected return on the risky asset minus the risk-free rate divided by the level of risk of that risky asset, sigma I. Now, if you then want to construct an actual write down the function, expression for the function, then expected return on the portfolio equals the risk-free rate plus this slope expression that I just put down over here. So divided by sigma I and multiplied by the specific level of risk of that portfolio. So if you want to check, for example, what's going to be the expected return on a portfolio with this much risk, well, you have to sort of extrapolate from over here, given a certain slope, given a certain intercept and a certain slope. That's why we've got a scaling here times sigma p. More on that in subsequent videos. In this video, we will be talking about diversity. In this video, we will be talking about diversification. In this video, we will be talking about diversification, but doing so in a sort of theoretical, non-numerical way. We already know that investors, at least on average, or statistically speaking, are by large risk-averse people, right? What that means is that we don't, it's not that we avoid risk completely, we're just interested, at least in our financial dealings, in reducing risk, but hopefully keeping returns at the same level, keeping returns the same, and if we can not change the return but make risk lower, that's brilliant. And in the previous video, you saw how we can reduce risk. That was standard deviation of a portfolio, how that can be done, or how risk may be diversified away. So this was diversification in a simple 2-asset portfolio. We employed that rather cumbersome formula to calculate it, and that was possible due to correlation, but correlation which was less than +1. Ideally, it was negative. That's what allowed us to reduce the level of risk down to 0. Let me just remind you that we had 2 assets. I believe they were called Y and Z, and if correlation was positive +1, then really that's standard deviation, that's expected rate of return on the portfolio. And if correlation was +1, the only thing we could do is play around with the weights for asset Y and Z, but the how much risk this portfolio created was just a linear weighted average of the 2 standard deviations. It was only when we started
In this video, we will be talking about diversification, but doing so in a sort of theoretical, non-numerical way. We already know that investors, at least on average, or statistically speaking, are by large risk-averse people, right? What that means is that we don't, it's not that we avoid risk completely, we're just interested, at least in our financial dealings, in reducing risk, but hopefully keeping returns at the same level, keeping returns the same. And if we can not change the return but make risk lower, that's brilliant. And in the previous video, you saw how we can reduce risk. That was standard deviation of a portfolio, how that can be done, or how risk may be diversified away. So this was, diversification in a simple two-asset portfolio. We employed that rather cumbersome formula to calculate it, and that was possible due to correlation, but correlation which was less than +1. Ideally, it was negative. That's what allowed us to reduce level of risk down to 0. Let me just remind you that we had two assets. I believe they were called Y and Z, and if correlation was positive +1, then really that's standard deviation, that's expected rate of return on the portfolio. And if correlation was +1, the only thing we could do is play around with the weights for asset Y and Z, but the how much risk this portfolio created was just a linear weighted average of the two standard deviations. It was only when we started to make or assume that correlation could be less than +1, heading towards 0 and then becoming negative, that we got results which were much more interesting in the sense of reducing the level of risk but keeping the amount of return the same. Remember, the expected return on a portfolio is just the weighted average of the returns on the individual assets. And we also said, I think, that for large portfolios, so those where N became quite higher, it was covariance, or in fact correlation. Covariance and correlation are very much related because correlation is standardized covariance, right? Covariance can take on any number, negative or positive, whereas correlation always fits in between -1 and +1. That's why we say it's standardized correlation or covariance among the assets is the primary determinant of portfolio risk. And when you go and solve the sort of end of chapter questions in your curriculum, in your learning ecosystem, you will find theoretical questions on this concept actually, which we explored towards the end of the previous video. Now, the challenge in portfolio construction is, of course, to find assets, or finding assets with low correlations, hopefully as low as possible, like below 0.5. Most assets are positively correlated, and most actually have high levels of correlation. And please also appreciate, this is something we often talk about, that correlations tend to change depending on how stressful times are. In times of big market stress, correlations tend to rise and increase towards positive +1. So you can't take correlation as a static measure. You can't take it for granted and treat it as something static. It does change over time. Now, your book discusses some avenues, so possibilities for diversifying, for diversification, and I want to run through that list of ideas so that you're comfortable with it. Most of it is, very kind of self-explanatory, but still. The first is diversify across different asset classes. So, when they talk about asset classes here, they mean things like, even if you think domestically within your own country, a separate asset class would be large cap stocks, right? So shares of large companies, and that is actually a distinct class from small cap stocks in the sense of the correlation not being all that high. And of course, corporate bonds are yet another class, and government bonds would be yet another asset class, and so forth and so on. You can kind of continue that list, and then you can do a similar split with non-domestic, like emerging markets or developed markets, but non-domestic, and have those asset classes, but within emerging markets, and then you can think in terms of sectors and different industries, like perhaps the construction industry being quite different, and shares of construction companies, irrespective of size, being quite different to something like pharmaceuticals. Just from the top of my head. So that's diversification across asset classes. Then they talk about diversifying, but with the help or with the use of index funds. And this is actually an interesting point. I'm going to explore this one a little bit further. So especially if you've got a small portfolio or a smallish portfolio, whatever that means, right? Diversification may prove a bit of a challenge. Diversification can be indeed problematic for smaller investment portfolios. Why? Because a sort of rule of thumb, but it's confirmed by empirical evidence, is that even if you wanted to, let's say, get yourself exposure to large cap stocks, you would probably need, and when I took the CFA exam, you had to know this, you would need approximately 30 stocks, so 30 different securities, to create a diversified exposure to a single asset class. So let's say you want to get exposure to, large cap stocks, American large cap stocks. It's not good enough to buy, some Meta shares or Alphabet shares or whatever. You would probably need to hold 30 odd different assets in the right proportions, maybe capitalization weighted or something like this, to actually say that that chunk of your portfolio, that large cap chunk, American large cap, is diversified. And when we say diversified, what we mean by that is we have more or less eliminated and diversified away the exposure to company-specific factors. This is something we'll talk about in subsequent videos, where we differentiate between systematic and non-systematic risk. So in order not to be exposed to the individual company-specific factors underlying the performance of a single company, that's non-systematic risk, you need to have a portfolio that consists of roughly 30 different securities to have that dealt with, for that to be a diversified portfolio. So this is to a single asset class, and now you need 30 for each of these classes. Multiply that by the number of asset classes, large cap, small cap, domestic, emerging market, bonds, etc., and you all of a sudden start having huge portfolios in terms of the number of stocks held or the number of different securities held. That becomes costly to trade, costly to manage, costly to track and monitor. So instead of buying individual securities, you may decide to use exchange-traded funds, which give you broad exposure to a specific market benchmark, like an index, and it can be an index of US large cap securities or small cap securities, emerging market, whatever, or indeed just mutual funds of some kind. It doesn't have to be ETFs, and this may actually be, because you're just doing a single transaction for each of these asset classes, may be more effective than trading individual securities, be they shares or bonds. That's what ETFs are great for, giving you that broad exposure. Right, something that may be quite natural and obvious for a lot of you, especially if you don't come from one of those huge markets or countries with the biggest financial markets in the world, but diversify among countries. The world doesn't end at your domestic market. Different countries have their own economic policies, their own political climate and economic climate, their own currencies, and all of that impacts the performance of securities denominated in those currencies and trading in those countries. So that's another avenue for diversification. Now, this one is also quite important. Diversify by not, let me emphasize, not owning stock of your employer, so your employer's shares. The CFA Institute is quite critical of that practice of employees owning their employer's shares, because that just leads to a lot of wealth concentration. You have to bear in mind that your own human capital is already invested with your employer, in the sense that your salary, your earnings depend on the performance of your employer, depend on their health. So, employer. Now, I know this may not be a problem for you, but it's more a sort of general remark for clients of investment advisors. So if you now, additionally to this, want to make a financial investment into stock of your employer, which obviously depends on their performance, that just leads to a lot of wealth concentration, which is not a good thing. I mean, wealth concentration leads to a lot of risk concentration. That's the opposite of diversification, and it's a bad idea. People who have a lot of wealth concentration because maybe they've inherited positions in companies, lots of stock, try and to great lengths to actually reduce that concentration. So you shouldn't consciously try to take it on board and increase it if you can avoid that. Right, another point: evaluate each asset before adding it to the portfolio. And what I mean by that is, evaluate its impact on the overall level of risk, which is all to do with, assessing that correlation and its impact. And your book does contain a formula for doing this evaluation sort of on an asset by asset basis. I've decided not to write this formula down and not to explore it. Why? Because it's just given, and then it's never really it's never applied in any example or indeed any sort of question set or end of chapter question. So I'm ignoring it, but doing it so consciously because I've evaluated the risk of it coming up. It's not the most intuitive of formulas. If it were, I would just write it down. It isn't, so I don't think you'll get tested on it. But that's my impression. Okay, and the final point, maybe not so obvious: get insurance. Buy insurance for risky portfolios. I mean, if something can be insured, brilliant. At least evaluate the cost of getting this insurance. Now, insurance treat insurance is something you pay for, so treat it just like any other investable asset. And the brilliant thing about insurance is it has negative correlation with whatever you're trying to secure here. If not insurance, maybe, think about commodities. Why? Such as gold, because they often may exhibit even a negative correlation, especially with stocks, in the sense that when the stock market is dropping, gold often picks up, although not always. When there is a panic sale in the market, people also liquidate gold positions just to generate liquidity, as COVID showed us, at least initially. Another idea could be put options, if they exist. Options are a form of insurance, and buying put options is insurance against price drops. So why not consider these? In this video, we will be talking about